Hey guys, welcome back to the channel. So today we're going to be diving into risk, right? More specifically, how much risk should you take when investing? A lot of people are like, "Hey, I want to earn as much as possible while being as safe as possible," and other people are like, "I want to risk a lot because the more you risk, the more return you get." And some people will tell you, use your age to when you invest for how percentage of stocks and bonds that you have in your portfolio, stuff like that. There's a bunch of different things, but let's get down to how much risk should you take when you're investing, right? There's a couple things we're going to talk about, right? Because if you're looking to invest, right, like that should be your top priority, right? Determining how much risk you should take, right? And risk sounds, it sounds scary. It's intimidating, right? Especially if you're not a risk taker anywhere else in your everyday life, right? But in investing, right, like we said earlier, the more risks that you're gonna take generally means more return over the long run, right? So you'll need to take at least some risk, but you need to do it in an appropriate dose, right? Take too much, and you might lose a massive amount of money right before you need it. Take too little, and your money might not grow to what you need it to grow to, right? So, we're going to go over 3 levels to determine risk level, right? So, we're going to start off with the first one. The first one's going to be establishing your goals, right? Because, you need to determine, quantify, and prioritize your investment goals, right? And this is going to be necessary, right? Because different goals, like an emergency fund, retirement, a down payment on a house or a car, they have different time frames that require different risk levels. So, goal setting, right, sounds very simple, right? But it's actually a lot more difficult than it appears. It's going to require answering a couple big questions like when will I retire? How much yearly income will I need? Should I buy a home? And if so, when and for how much? Right? Then you're going to want to, or really you're going to need to prioritize those goals and allocate, a certain amount of money, right? The limited money you have to save for those, right? And these questions are hard to answer, and there is no perfect answer, right? So you really need to make your best, your best guess, your best estimate for each goal that you have, right? The second thing we're going to talk about is assessing your risk capacity to determine general risk allocation, right? Because risk capacity helps you understand the optimal amount of risk you could take in order to maximize the chance that you reach your goal, depending on how far you are from that goal, right? If you're further away, you can handle the risk that your portfolio loses money for short periods, right? These bumps are going to smooth out over time, and investors tend to earn a higher return for bearing more risk. In other words, high risk capacity investors, um, are just, gonna, how do I want to word it? The people who are able to take on more risk earlier on are gonna have or generally earn more in the long run, right? Right. So what counts as a long time in investing, right? Well, generally, it's 10 or more years away, which makes retirement a prime example. Because investors in their 20s and 30s are so far away from retirement, right? So they can load up on risky investments like equities, right? Which are going to offer long term returns, but are prone to price volatility, right? Along the way. Um, One of the websites I mention, frequently is Morningstar, right? Morningstar's lifetime allocation indexes can give you like a good starting point for your allocation, right? So let's take an example, right? So let's say you're let's say you're 20, right? And you want to retire at 60. Okay? So you're 40 years away from retirement. you could target about 90% in stocks and 10% in bonds and cash, right? But those percentages should shift and adjust as the portfolio becomes, it should be becoming more conservative over time, right? So maybe every 5 years you shift it 10%, or every 10 years you shift it 15%, or something like that, until you eventually, the closer and closer you get to retirement, the more and more you have in bonds, right? Plus, you can fine tune your exposure depending on how aggressive or conservative you want your portfolio, while still staying within the recommended risk range, right? But meanwhile, short and intermediate term goals require less risk because your portfolio has less time to recover if the market drops. So, you would own more bonds and cash when saving for a short term goal, but the amounts vary greatly depending on your specific time horizon. If you are saving for a goal that is or fewer years away, right? So if you're saving for something, let's just say 1 to 3 years away, you should generally hold all cash. On the other hand, if your goal is around, say, 10 to 12 years away, right, that might include a small helping of stocks in your portfolio. If you're unsure how to translate your risk capacity into an allocation, there are some general guidelines and recommended portfolios based on time horizon. I know the company I work for, right, they have specific funds set up with specific retirement dates. So like the end of them will be like the year, right? Like 2065, 2070, 20, stuff like that. So let's get on to the third one, right? Tweaking your risk capacity based on risk tolerance. So, your risk capacity should largely dictate your risk level, but you might also examine your risk tolerance on how market swings make you feel. You might know short term losses won't ruin long term returns, but how uncomfortable does a 40% portfolio decline make you feel? It's hard to know until the situation arises, but if you think it would make you feel uncomfortable, then you might have a lower risk tolerance. Investors who don't consider their risk tolerance might harm themselves by adjusting a portfolio's risk at the worst time. If a portfolio loses 40% of its value, a risk averse investor might get so anxious that he or she swaps out of stock holdings for bonds and cash. However, these adjustments can minimize how much of the eventual rebound her portfolio captures, decreasing the likelihood that the investor will reach his or her goal. But if the portfolio was less risky from the beginning and therefore declined by, say, about 25%, an investor with a low risk tolerance might feel comfortable enough not to make any changes, right? And on a side note, right, that risk tolerance adjustment, the adjustments, like, they need to be small. You're investing for a specific goal, so if your adjustments prevent you from earning a return needed to reach your goal, you've defeated the goal-based investing's purpose, right? Instead of adjusting your stock and bond allocation, you could also fine-tune the stock and bond investments, right, that you own, right? Investors with a high risk tolerance could consider a heavy helping of small cap stocks, for instance, right? So really, it just comes down to, you know, seeing how comfortable you are with seeing big dips or small dips or medium dips in your portfolios, and adjusting, your cash and bonds ratio to stock ratio that way, right? Like, I know I'm about to be 33, and I know that I still have about, 20 something years until I retire, and I'm heavy in the stocks, because, and like I said earlier, every 10 years I'll adjust, or not, every 5 years I'll adjust my portfolio from stocks to bonds in move percentages, right? So, if that's something you guys are into, you might want to go look into, the age based stocks to bonds ratio, which is, really helpful and really good. But I really hope you guys enjoyed this video. I hope you guys got some good information out of it. And until I see you guys in the next video, y'all be good.